Recapping this hour's inflation data, November PPI coming in hotter than expected on the headline and the core numbers. For more on the markets and the market reaction right now, I want to bring in Brenda Vingiello, Chief Investment Officer at Sandhill Global Advisors, also a CNBC contributor. You're watching the markets moving lower already as expectations that maybe Jay Powell is going to say inflation's still here. What do you think?
I think we need to wait to get the CPI number next week, but I will say that this figure, the PPI this morning, is certainly a disappointment, showing that it appreciated more than twice, around twice what was expected month over month, and that core number is where that came from. So that is certainly a disappointment here. So I think this whole week we've just seen signs of the strength of in the services sector, and then last week, of course, with the strong job number. So it seems like things are stacking up in favor of the Fed continuing on its rate hiking path. But certainly we need to see that CPI number next week. But
okay, so what's your Fed rate hike number for next week? But maybe more importantly, how are you seeing things play out now in 23?
So I think we're going to see the 50 basis points. If we see anything other than that, it's going to be definitely a surprise to the market. For 2023, I think we could see, let's say that next week turns out to be better than expected. We get a better CPI number. I think that could support ongoing appreciation in the market through the end of this year. But I think as we look to next year, we're talking about kind of bumping up against the high end of the valuation range that we think is appropriate for the S&P 500. So I think in a world where there is an opportunity to earn a risk-free rate of return of around 4% and potentially a little bit higher, then that just begs the question of where does the best risk reward lie? And we think that all signs are pointing to the bond market being more attractive in that scenario if we were to get further.
So you're feeling like 4% is better than whatever you're going to get in the equity market?
I think if we start to bump up against, let's say, an 18 forward multiple, you just have to beg the question of, how much further can we go in this environment where there's an overhang of just not knowing exactly what the impact of the rate hikes that the Fed has done so far is truly going to be on the broader economy. So I think that's an overhang, especially in areas of the market like large cap equity, where valuation is okay, but it's not a screaming buy currently. Other parts of the equity market are looking a little more interesting from a valuation standpoint, but obviously we have to all consider fundamentals too and what those look like if we truly do get an economic slowdown next year.
Are you already buying bonds? Is that the move for you?
We have been. So, starting mid-year this year, we started adding to bonds to our portfolios for the first time in many years. And that's a significant change. But I think when we look at the role of bonds, especially if we do go into a recession, we think they will resume their typical role of being more of a protector. And that's important, I think, in the context of having a diversified allocation for many people.